All right. Good day to everyone. You're all welcome to our session today. Here is Pros and Cons Accountancy Tutorials. And my name is Edward, and you can call me Ed. So we want to continue with our session on IAS 16. The last time we met, we were able to deal with some of the issues, talking about our definition, the recognition criteria, the initial measurement, the subsequent measurement, where we talk about the cost model and the revaluation model. We were able to deal with it and even dwell much more into the revaluation model, where we talk about revaluation at the beginning of the year, revaluation in the middle of the year, and then revaluation at the end of the year. In effect, we were able to deal with the questions on the initial measurement. For the initial measurement, we said is the purchase price plus your what plus your any other attributable cost for making the asset useful, and also or for getting the asset for its intended use, yes, and also the site restoration cost. Good thing is we were able to solve some questions to even have a question to deal with the site restoration cost by bringing it to the present and how it's going to be classified in our financial position. So today, our focus is to look at some issues on depreciation and the revaluation issues or scenarios on the revaluation, right? Remember, we made mention that in revaluation, they may decide to change what? They may decide to even change or also revalue what the useful life. So we want to solve some scenarios where the life of the asset has been revised in connection with what? The asset amount or the revalued what? Amount. So this is what today we want to look at. Then we look at the subsequent expenditure. For subsequent expenditure, I think it's something that we can explain. So when we talk about the subsequent expenditure, it is something that we are a cost that we are incurring as part of the initial cost that we spent, right? But with this, the idea is that we are spending something which can be capitalized, amount which can be capitalized or can be expensed. The question is, at what point do we say we are expensing that amount we have incurred? And at what point do we say we are capitalizing the amount we have incurred? We can only say we want to capitalize the amount we have incurred if it is going to improve upon the economic benefit that we are getting from the asset. Right? What is the definition of PPE? It's a tangible asset held by an organization and controlled by them for more than one accounting year, and the uses it for production and rendering of services, administrative purpose, and then rental to others. Now, we also made mention that the recognition criteria is that it is probable for it to be recognized. So if we are capitalizing something, it means we are recognizing, if we are capitalizing a cost, it means we are recognizing it as part of cost of asset. So it's like we want to capture it as an asset. And if we capture it as an asset and it cannot what? Bring economic benefit, it cannot accrue economic benefit, there is not going to be any flow of economic benefit to the entity, then it means we can't capitalize it, but rather what? Expense it. So a cost that you have incurred as a subsequent expenditure on the asset, which will improve upon the economic benefit that we are getting, then we say that cost should be capitalized. So let's use vehicle as an example, right? So if you have a vehicle and you go and change the inside mirror, the mirror that sometimes we use it to watch our face, the back of the car here and there, will that improve the economic benefit we're getting from the car? Do we think if we change that, the car can move from, let's say, Kumasi to Accra? That is no. The car cannot move from Kumasi to Accra. Or the car cannot move from Accra to Kumasi if we should just change the mirror. No, that is not it. But if let's say you have a car and that car can only move from Accra to Kumasi and cannot continue to, let's say, Sunyani, right? But you decided that, okay, let me change the engine. Because if I change the engine, then that car should be able to move from Accra to Sunyani. Look, when we talk about economic benefit, it's not only about cash, receiving cash or revenue. Anything which is like improving on something, this what it means you are generating what economic benefit. You may generate economic benefit, which is not cash flow. So the car being able to now move from Accra to Kumasi to Sunyani, it means its economic benefit that we are getting have increased as compared to when it could only move from Accra to what? Kumasi. And it's not because of the mirror that you change, no. It is because of what? The engine that you change. So that engine becomes what? More or less something we can capitalize as part of the cost of the asset. So that is the idea on what the subsequent measurement. So the subsequent measurement, anything which is any cost which is going to improve the economic benefit of the assets, what do? You capitalize it. If it will not improve the economic benefit, then we expense it in our P&L. Sorry, in the P or L. We expense it in the P or L. That is the idea on the subsequent measurement. Now, in terms of disposal, for disposal, it means we are taking off the asset. We are selling the asset out. And if, let's say, I was holding an asset of about 2,000. If, let's say, I was holding an asset and that asset was costing me, that asset, the carrying amount was 2,000, but it was disposed. So disposal came in for 4,000. Then it means I've gotten a disposal gain. Disposal gain. Disposal gain of 2,000. And that disposal gain of 2,000 will have to go to my POL. The other scenario is where the carrying amount was 4,000. And then here, the disposal was 2,000. Yes, there's a disposal loss, right? There's a disposal loss of 2,000. Yeah, it also goes into our P or L as disposal loss. We add it to our operating expenditures. Disposal loss. Okay. So surely this is how the disposal is also going to be. But where the asset was revalued, right? Where the asset was revalued before the disposal came in, we will have to check and see if the asset had a certain revaluation gain already in the company. Let me come back again. This scenario that we just had is when there was no revaluation on the asset. The asset has been in the company, no revaluation has been on it. So what do? It means we just let it go. The loss and gain to P&L, POL, and that's all. Okay. We are talking about where the asset was in the company and there was a revaluation gain at OCI on this asset before the disposal came in. So surely for the disposal loss or gain to P or L. What about the recognized OCI? The question is, what about the revaluation surplus that we are keeping on this asset? What do we do to it? So the revaluation surplus that we are keeping in our OCI. Remember, the asset has been disposed. So what is it doing over there? Let's clear it off. So what will happen is we will move that OCI value or the revaluation surplus relating to the disposed asset and take it to what? And take it to retain it. So we are realizing it because the asset is gone. We've disposed it off. So if it is at OCI, we can't use it in place of any other asset because the idea of OCI is that it's other comprehensive income, right? So if we do revaluation on that same asset and we get a loss, we're going to subtract from it, right? But there's a situation whereby that asset has been disposed and we can't use any asset loss to go and subtract it from the disposed asset gain. No, you can't offset one asset loss with another asset gain. It goes hand in hand, matching concept. If this is what brought the gain, its loss is what can be attributed to it. If not, no asset can be used, right? So once the disposal is gone, then what do? We bring the OCI value, which is the revaluation surplus on that asset, and give it to what? The retainer. Take it to retainer. That is the concept of disposal loss. Or that is the concept on disposal where there's what? Where there has been a revaluation gain earlier. Okay, so this more or less brings us to the end on the sessions on the areas on what IAS 16. Now, when we talk about deal recognition, that's the simplest because deal recognition simply means we are not going to use the asset again. So let's take it out from our financial statement. That one we will just take it out from our financial statement. But let's have some scenarios which will take us on the revaluation, these disposal issues, and any other issues which will come up under what? Under investment, under PPE. Any case, if there's something that we didn't talk about, please, you can still reach out to us so that we can deliberate and see how best we'll be able to help. All right. So let's take some scenarios and deal with the issues on revaluation, issues on disposal, and then we can end our session. Okay, so wait this a minute to share my screen with a question. Okay, so this is our scenarios. The last time we met, we were able to deal with illustration 1, illustration 2. We dealt with the continuation of illustration 2, which was the site restoration or dismantling cost. Then we also dealt with the illustration 3, I believe so. And okay, so I think that illustration 3, we did not deal with illustration 3. So we have to do with illustration 3, which is basically about depreciation, right? So an asset was purchased for 100,000. It has an expected useful life. That's expected useful life of 10 years. The company, however, intend to use the asset for 6 years. So they are going to use the asset for 6 years, at which point its expected residual value will be what? 40,000. So the last time we talked about depreciation, where you will be given what? Residual value. But the question we did, there was no residual value, so it was a straightforward question. Here we have a residual value. So we have to take the residual value before what? We can divide by the useful life. So let's go to the board and deal with this. The cost is what? 100,000. And then the residual value is 40,000. That is at the CCA, right? And we are given the useful life of how much? 6 years. They will use it for 6 years. So what will be the depreciation? It means our depreciation is going to be what? 100,000 minus 40,000 divided by 6 years. So that will give us 60,000 divided by 6 years, which is equal to 10,000. So the current amount is going to be how much? It's going to be 100,000 minus 10,000 depreciation, giving us 90,000. So in our POL, we have a depreciation of 10,000. And then in our financial position, we will have an asset of 90,000. So this is the scenario that we have, the illustration that we have. Okay, let's see. Today I want us to try and then complete our illustrations so that we can move on to other things another time, right? So here we have depreciation whereby there's a revision of what useful life. There's a revision of what the useful life. So on January 1st, 2015, BB purchased heavy duty equipment for 400,000. On the date of installation, it was estimated that the machine had a useful life of 10 years and a residual value of 40,000. Accordingly, the annual depreciation worked out to 36,000 because if you have 400,000 minus 40,000, you get 360,000. Then you divide by 10 to give us 36,000. So that's what was done and it's accurate. Remember, they started on what? 1st January 2015, right? But on January 2019, it means 15, 16, 17, 18, 4 years is gone. After 4 years of using the equipment, the company decided to review the useful life of the equipment and its residual value. Technical experts were consulted. According to them, the remaining useful life of the equipment at January 1st, 2019 was 7 years, and the residual value was what? 46,000. So now, first thing is that they've used this asset for 4 years. So we will calculate depreciation here for 4 years and subtract from the cost of the asset so that we can get what our carrying amount as at the end of the 4th year. Then the beginning of the 5th year, they told us that we want to change the asset. We want to revalue the asset, right? We want to revalue the assets. Surely they didn't revalue the carrying amount. They decided to change what, revalue what, or revise what, revise the useful life. So if something is 10 years, we have used 4 years. The useful life should have been left with what? 6 years. But when they came, they said, oh, no, the asset is strong. We should use it for 1 more year. So it should be 7 years. However, the residual value, which was 40,000, should be what? 46,000. So let's go to the board. We have to compute the revised annual depreciation for the year 2019 and future years. Okay. So now, if you come here, 2015, the cost was 400,000. The cost was 400,000, right? And we have residual value of 40,000. And then the useful life of how much? 10 years. So what should be our depreciation? Our depreciation per year was supposed to be 400,000 minus 40,000 divided by 10. And that will give us 400 minus 40 divided by 10, giving us 36,000. But if you use it for how many years? 4 years. So accumulated depreciation is going to be 36,000 times 4, isn't it? So accumulated depreciation, that's for 4 years, times 36,000. And 36 will give us 4 times 36. 4 times 36 will give me 1. So 144,000. So it means January 2019, our carrying amount should be equal to 400,000 minus 144,000, which will give us 256,000. Which will give us 256,000. And we are supposed to calculate yearly depreciation from 2019 onwards, right? So what is going to be the depreciation from 2019 going? From 2019, they revised the useful life. The useful life should have been what? 10 minus 4, which will be 6. But they said, hey, let's use what? The revised one. So revised useful life is now at 7 years. Revised useful life is 7 years. And then revised what? Revised residual value is also 46,000. It's also 46,000. So then our depreciation, we know our depreciation is what? The cost this time around, we don't have the initial cost, but we have a current amount. So current amount minus what? The residual value divided by the useful life. So our depreciation will be equal to carrying amount minus what? The residual value divided by useful life. In this case, the revised useful life, right? So when we go, you know that the carrying amount, okay, let's solve it. The carrying amount is 256,000 minus the revised residual value 46,000 divided by the revised useful life of 7 years. So 256 minus 46 divided by 7 will give us 30,000. So depreciation is equal to 30,000. So at the end of 2019, carrying amount is going to be what? 256,000 minus 30,000, which will give us 226,000. So our POL in 2019 is going to have depreciation of 30,000, and then our financial position will have the asset of how much? 226,000. 226,000. So that is the idea of this scenario. Right. Okay, let's look at scenario 5. That one too is about revision of what? Useful life. Revision of useful life. Now, the financial statement for the year ended 31st December 2017 are being prepared. An asset was purchased on 1st January 2015 for 100,000, and a straight line depreciation of 20,000 per annum has been charged up to what? 31st December 2016, right? So something that we purchased it in 2015 January, and then as at 31st December 2016, we charge every year we have been charging what? We have been charging 20,000. So it means we've used it for how many years? 2 years. January to December 2015, January to December 2016. So that is 2 years. So in effect, it should be left with what? 60,000. It should be left with 60,000 as at the end of 2016. Okay. Following the annual review of useful lives, it was determined that as at 1st January 2017, the asset had a remaining useful life of what? 8 years. It had a remaining useful life of 8 years. So if an asset is 100,000, every year the depreciation is 20,000. It simply means the useful life is 5 years. The useful life is 5 years. And we've used 2 years, so it should be what? 3. It should be left with just 3 years in 2017. But they said that, hey, my friend, this asset is too good. So let's use what? 8 years from 2017 going. We use 8 years. So we have 60,000, but the useful life is what? 8 years. So let's go and deal with this as fast as possible. So we have costs of 100,000, right? And then we have useful life, or we have yearly depreciation. Let me say accumulated depreciation. So with accumulated depreciation, because we use it for 2 years, it will be 20,000 times 2 years. That is up to from 2015 and then 2016, giving us 40,000. So in effect, we are supposed to get 60,000 as the current amount. When we came to 2017, we were expecting to use a current amount of what? 60,000 from January, right? Then we charge depreciation of what? 20,000. But they are saying, hey, my friend, no, we've changed the useful life. We are now using a useful life of 8. Using a useful life of what? 8. So the useful life is now 8 years. So here is 8 years. So our depreciation will now be how much? 60,000 divided by 50,000 divided by 8 years. So if you have 60 divided by 8, you are getting 7,500. So that would be 7,500, right? 7,500. So what would be the current amount? So now the current amount is going to be 60,000 minus 7,500 depreciation. That will give us 52,500. 52,500. This will be the current amount. Our financial, our POL, will have the depreciation of how much? Of 7,500 as at 2017. As at 2017. And then the financial position will have the asset as at 2017 to be what? 5,500. 5,500. 5,500. All right. So this is the idea of the scenario that we have. Okay, so let's look at our scenario 6. Scenario 6, which is about revaluation of PPE, and that is a subsequent what measurement. In fact, we dealt with revaluation first our earlier video, but we want to use scenarios to explain to the best understanding of our viewers, right? So pros revalued its land and building at the start of the year to 10,000, and it's comprised of what? 4,000 for the land. The property had originally cost 5,000 earlier, including 1,000 for the land, when it was purchased 10 years ago. The total expected useful life of 50 years remained unchanged. And then pros policy is to make an annual transfer of realized amount from the revaluation surplus to retain earnings. Please, when you see a statement like this, where your policy is to make an annual transfer of realized amount from the revaluation surplus to retain earnings, what does that mean? It simply means that when you do a revaluation, there's a possibility that our depreciation will be higher than how it was. So you've done a revaluation, you've gotten a gain, so you've taken that gain to OCI. Okay, that's fine. But because of this revaluation, we are getting a higher what? A higher depreciation as compared to what we were getting earlier. And where do we take revaluation to? We are taking the depreciation. We are taking the depreciation to our profit or loss. In this case, it means whatever profit we are expecting, that the excess depreciation is going to reduce it. So if, let's say, we were incurring depreciation earlier to be 1,000, and because of the revaluation, we are now getting what? 1,500. There's an excess depreciation that we are now incurring of what 500. And this scenario means that that profit or that excess or that revaluation gain, which we've placed or we've recognized under OCR, what is it doing over there? Why are we incurring so much cost, reducing our profit, whilst there's a certain gain on an asset that we revalued, which even brought that cost? That gain is sitting somewhere. Why is that gain sitting there whilst we are incurring? Let's bring part of that gain and then put it under what? Our retained earning. So the idea is that for that year, yes, the full depreciation will be in our POL. But when we finish everything and we come to our statement of changes in equity, we are going to charge the excess depreciation that we incurred in our POL. We are going to charge it to what? To the OCI account, so that we will bring part of the OCI account, that same amount from the OCI account to the retained earning. The question I know you are asking yourself is, why to the retained earning and not the POL? Good. You know that gain on revaluation, we don't keep it under POL. So we can't just go and take that and bring it to POL. So, but we can recognize it as part of what? Recognize it as part of our retained earning. One other issue is, you know that this thing, our dividends, sure, dividends are paid out from what? Retained earnings. Dividends are actually paid out from retained earnings. Now, the shareholders will be there and be thinking that this year, because the profit was less, the dividend has come down. Charlie, that gain, what at all is it doing there? It's because of that. It's because of the revaluation, which is bringing the higher cost. And at the end of the day, it has even put some gain somewhere. Go and bring part of that gain in connection with what? The excess depreciation. Add it to the retained earnings so that it will be like what we are expecting. Then you give us our dividend. So that you can give us what? The dividend we are looking for. So me as a shareholder, I don't want to lose. Because no organization also want their shareholders to see that things are not going well. No. Because the shareholders will now start asking, why is our dividend now coming down? We that we have put our money into the company, we'll be asking, why is our dividend now coming down? What is happening? What is the issue? So the best thing is, you are having some gain over there because of a revaluation you did, which brought the cost to even reduce what? The profit to retain earning. So now, the excess cost that we incurred, which brought a gain sitting somewhere, please go and take that excess cost from that gain and come and add it to our retained earning so that we can get what? The dividend we are looking for. So that is the idea of the annual transfer of realized amount from the revaluation surplus to retained earnings. So when we get there with this question, we are going to do such a scenario so that we can take the annual, we can take the excess depreciation from the revaluation surplus to the retained earnings. Now let's go on. So now, pros revalued the land and building to 10,000. Initially, it was what? 5,000, right? 1,000 for land and then 4,000 for building. Then it came to 10,000, where 1,000 is for 4,000 is for land, and then 6,000 is for building. We have used it for what? 10 years. So let's go to the board. We have used it for 10 years before the revaluation came in. Okay. So what we are seeing here is that the initial cost, right? The cost was 5,000. So we have land, and then we have building. So let's bring the total here. So the land and building, the initial cost was 1,000, and then 4,000, giving us the total 5,000. We do not depreciate land, please. I beg you. We do not what depreciate land. Land is not depreciable. So we do not what depreciate land. So what we are going to do is that we will move on and then depreciate what? Building. So the useful life is 50 years as it was given. 50 years. Okay. Now our depreciation is going to be on the building, which is 4,000 divided by 50, right? Divided by 50. But they said on this, we use it for how many years? 10 years. We use it for 10 years. So divided by 50 times 10 years. So the accumulated depreciation will be what? For 10 years. For 10 years. So 4,000 divided by 50 times, sorry, 4,000 divided by 50 times 10 is giving me 800. It's giving me 800. So we have 800 here. 800 as the depreciation. So we are going to get carrying amount before revaluation to be what? Here to be 1,000 and then here to be 3,200. So in effect, total carrying amount is 4,200 before the revalued amount came in. So revaluation came in and it was 10,000. So total revaluation is what? Revaluation amount is 10,000. They said 4,000 relate to what? The land. So 6,000 will relate to the building. What is our revaluation gain? Our revaluation gain is what? Is 5,800. Our revaluation gain is 5,800 because here is 3,000 and then here is 6,000 minus 3,200 give us 2,800. So it gives us 5,800. Okay, fine. This revaluation amount, when did we see the revaluation amount? The revalued amount came in at the start of the year. Start of the year. So it means we can calculate depreciation on the revalued amount, isn't it? Now the question you ask yourself is, what was the initial depreciation? Initial depreciation is what? 4,000 divided by 50. So that one was 80 cedis per year. 80 cedis per year. But now we have 6,000 divided by 40. And that is giving us 150 per year. So depreciation now is what? 6,000 divided by 40 years. 6,000 divided by 40 years. So depreciation now is what? 6,000 divided by 40, giving us 150. Giving us 150. So if you look at it, our carrying amount as at the end of the year is going to be here 4,000. And then we have 6,000 minus 150, which will give us 5,850. So 5,850 plus the 4,000 give us 9,850. So that is our carrying amount at the end of the year. Okay. Now there's this revaluation surplus, which is there doing nothing. But we have incurred 150 instead of 80 per year. We are incurring what? 150. So there's the excess depreciation is equal to 150 minus 80, which is equal to 70. So it is this 70 that we will transfer from the revaluation surplus or the OCR and then bring it to where? Bring it to retained earnings in our statement of changes in equity. So statements of changes in equity, normally some students find problem when dealing with statement of changes in equity. It's not difficult. It's basically the equity part of the financial statement. And what are some of the items which comes under the equity part of the financial statement? Just put them here. Some of the items which comes, which are part of the equity side of the financial statement We will have ordinary shares. We will have revaluation surplus. We will have retained earning. We will have uh, share premium. So these are some of the items which we put under what under our uh, our equity side. So it's just that one that you need. So if you check your trial balance, if there are balances, you see the balances. You see the balances, then you bring it. You see the balances, then you bring it. Then if there's any addition, you bring the additions. So if you look at what we are doing, there's no balances that we have. We do not have any balances. We don't have any balances. But we have addition. And that addition, one is what? One is the revaluation gain that we've gotten. And that revaluation surplus is 5,800. 5,000. So there's no addition to any of this. So we bring our total. Bring our total, which is 5,800. Now they are saying that we should move something from where? We should move the excess depreciation from revaluation reserves and go and put it under what? And go and put it under retained earning. So what is going to happen is that excess depreciation, we will take excess depreciation of 70 from here and bring it to where? Bring it to retained earning. That's what we are done with our statement of changes in equity. So the statement of changes in equity is just the balances and any addition, then any change that you have to effect. That's all. That's all. And I made mention that if let's say our last um, 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 meeting, I made mention that if let's say we have a disposed asset, right? A disposed asset, which was having a revaluation gain under revaluation reserves or OCI, we would have moved it and then take it to retain earning. That's also another change which will happen. With here, we can also pay what? Dividend, right? We can also pay what? Dividend. So if there's dividend, we would have bring dividend. And then dividend is paid out from where? Retain earning. Then we come and put it here. Right. So basically, this is what the question needed from us. This is what it needed from us. So you just bring your totals. Let's bring your totals. So here we have 5,800 minus 70, giving us 5,730. And then here we've seen some 70 addition. Here is dash. Then here we have 5,800. So by the time we go and present everything under our equity side in the financial position, we are going to have a total of what? 5,800. This total, if we add everything, that's what we will get. So the statement of changes in equity is one of the easiest that we can get at the during exam or any professional issues that we are dealing with, right? Okay, so that brings us to the end of this scenario. Brings us to the end of this scenario. And I wish we'll be able to deal with the last question, which talks about the disposal, right? Let's deal with the last scenario, which talks about disposal as fast as possible so that we can close our session. Now, joint C, purchase a property on 1st January 2004 at a cost of 750,000. The property had an estimated useful life of 10 years and no residual value, right? On 31st December 2004, the property was revalued to 810,000 and a revaluation gain of 130,000 was recorded on other comprehensive income. There was no change to the property's useful life, and then joint C does not transfer excess depreciation on revalued assets to retain earnings. What we did earlier, they don't do, right? On 31st December 2006, the property was sold for 900,000. Explain how the disposal of the revalued assets should be treated in the financial statement. for the year ended 31st December 2006. So as we said earlier in our last video, the asset has been disposed. It had a revaluation gain of 130, right? So if we dispose it, the disposal gain or loss goes to the P&L. But the revaluation gain that it has had, we will now realize that revaluation gain under what? Under the retained earning. Under the retained earning. So I want us to capture this as an assignment, try our hands on it, deal with it. If there's any issue that you are not getting clear, you can put your issues under the comment section. We are going to look at it. We also have our numbers here, so you can also contact us. Even I think on the page we have on our YouTube page, we have our numbers there. Even if you check our videos, you see that we have our numbers also there. So you can take our number, WhatsApp us, or call us on any issue that you are facing based on this or any other professional or academic issues relating to account. We will be able to talk to you and then find solutions to it. My name still remains Edward, and you can call me Ed. Here is Pros and Cons Accountancy Tutorials. Please, at this juncture, kindly like our video, subscribe to the page, and then share the videos also for us, right? We appreciate your calls, your encouragement, and then the likes and watches that you give to our videos. Thank you very much. And this is where I call it a close. God willing, we will meet again. Bye-bye.